East just broke the financial system. Ladies and gentlemen, Asian guy here. We are not using hyperbole today. We are not using clickbait. We are looking at mathematical impossibilities occurring in real time. We are witnessing events that should not be possible in a functioning market. We are watching the global financial architecture crack in front of our eyes, and most people have no idea it's even happening because they're too busy shopping for last-minute gifts. At 3:30 a.m. Eastern Time, the Shanghai Gold Exchange, that's SGE for short, and the Shanghai Futures Exchange, SHFE, didn't just open their trading day like any normal morning. No, they detonated. They exploded. The price action that occurred in those first 30 minutes of trading wasn't just unusual. It was unprecedented. It was the kind of movement that makes risk managers wake up in cold sweats. We have been tracking a divergence between East and West for months now. We've been telling you, week after week, video after video, that this moment was coming. We told you that China was systematically draining the physical metal out of the Western vaults, while New York continued playing its paper games. We showed you the vault data. We showed you the export numbers. We showed you the mounting evidence that the two markets, the Eastern physical market and the Western paper market, were slowly drifting apart like tectonic plates before an earthquake. But what happened 3 hours ago is not a divergence anymore. This isn't two markets moving in slightly different directions. This is a full decoupling. This is the moment where the entire global pricing mechanism for silver, a mechanism that has existed for decades, that has survived multiple financial crises, that has weathered the collapse of currencies and the rise of new powers, this mechanism has finally, catastrophically, broken apart. I want you to look at this number very carefully. I want you to understand what you're seeing because the implications are absolutely staggering. $77.89. That is the closing price of silver in Shanghai today, converted to US dollars. Not yuan. Not some theoretical number, actual US dollars per troy ounce, 77.89. Now, I want you to look at another number. Look at the price on the COMEX in New York right now as I'm recording this, $72.23. Maybe it's even less by the time you're watching this video. Maybe it's 72 flat. Maybe it dipped to 71 and changed during the thin holiday trading. Do the math with me right now. Pull out your calculator if you need to. Take $77.89. Subtract $72.23. What do you get? $5.66 per ounce. Let that sink in for a moment. A $5.66 spread between the same commodity, the same metal, trading on two different exchanges on the same planet at the same time. In the history of the modern precious metals market, and I'm talking about the computerized, interconnected, globally arbitraged market that we've had since the 1980s, we have never ever seen a sustained spread like this between major exchanges. Never. Not during the 2008 financial crisis, not during the COVID crash, not during any period of extreme volatility or market stress. Historically, when you look at the difference between London prices, New York prices, and Shanghai prices, you're measuring differences in cents, maybe 50 cents on a normal day to account for time zones and delivery logistics. In periods of extreme volatility, maybe during a flash crash or a sudden geopolitical event, you might see spreads of $1 or even $2 for a few minutes, maybe 5 or 10 minutes at most before the arbitrage mechanisms kick in and the prices converge again. But $5.66, sustained for hours? This isn't a spread anymore. This isn't market inefficiency. This is a crime scene. This is evidence of a broken system. A $5.66 gap means that the global arbitrage mechanism, the invisible network of traders, algorithms, banks, and logistics companies that keeps prices aligned across different markets, has completely snapped. It's broken. The fundamental assumption that underlies all of modern finance, that prices for the same asset will converge across markets through arbitrage, that assumption is dead. Let me explain what should be happening right now under normal circumstances. If silver is trading at $72 in New York and $77 in Shanghai, creating a $5.66 gap, then every bank, every hedge fund, every sophisticated trading firm, and every algorithm on planet Earth should be doing one extremely simple thing: buying silver in New York at $72, arranging immediate transport to Shanghai, selling it there at $77.89, and pocketing the difference. That's $5.66 of pure risk-free profit per ounce. Multiply that by 100,000 ounces, and you've made over $500,000. Multiply it by 1 million ounces, and you've made $5.5 million in profit from a single arbitrage trade. This is what we call free money in the trading world. It's the easiest trade imaginable. You don't need to predict the future. You don't need to analyze fundamentals or charts. You don't need to worry about timing or sentiment. You simply buy low, ship, sell high, repeat. It's mechanical. It's guaranteed. It should be happening automatically. So why isn't it happening? Why is the gap not only persisting, but actually getting wider by the hour? Why, instead of converging, Are these two prices moving further apart? There's only one explanation. And it is the one thing that the bullion banks, the central banks, and the financial authorities have been absolutely terrified of for 50 years. They cannot move the metal. They cannot execute the arbitrage because when they try to buy the silver in New York at $72, they discover something horrifying. It isn't actually there. The price that you see on your screen, that $72.23 on the COMEX, that's just a number. It's a paper price for a contract, a promise, an IOU. But when someone tries to convert that paper promise into actual physical silver bars that you can load onto a plane and fly to Shanghai, the system breaks down. The price in Shanghai, that $77.89, that's the real price. That's what people are willing to pay for actual physical, hold-in-your-hand silver that exists in the real world. That's the price of reality. The bridge between the paper world and the physical world has collapsed. And on this Christmas Eve, while families gather and presents are opened and carols are sung, the banks are trapped in the wreckage, watching their entire system crumble in real time. Before we dive deeper into the specific vault data, and I promise you, we have breaking news on the Asahi Vault that will absolutely shock you, we need to talk about something that most people, even experienced traders, don't fully understand. We need to talk about velocity. We need to talk about acceleration. We need to talk about how the speed of this rally is telling us something terrifying about what's coming next. Human beings are fundamentally not wired to understand exponential functions. Our brains evolved on the African savanna, where almost everything moved in straight lines. If you saw a lion 300 meters away yesterday and 200 meters away today, you could predict it would be 100 meters away tomorrow. Linear thinking. It kept us alive. But markets don't move linearly when they break. Markets move exponentially. And when you're inside an exponential move, your linear brain tells you it's impossible. It's a bubble. It has to crash because it simply cannot process the rate of change. Look at the timeline of this silver rally. Look at how the intervals compress as the price explodes. This is crucial data that reveals the true nature of what we're experiencing. To go from $20 per ounce to $30 per ounce, it took the market 145 days, almost 5 months. That's nearly half a year of grinding, daily price movements, consolidation, resistance, support levels being tested. It was slow. It was methodical. It was the kind of bull market that value investors love. Steady, predictable, allowing plenty of time to build positions. Then to go from $30 to $40, it took another 145 days. Same time frame, same grinding pattern. Still linear, still predictable. Bulls were happy but not euphoric. Bears were concerned but not panicked. The media barely noticed. It was still flying under the radar. But then something changed. The pattern broke. From $40 to $50, it took only 39 days, not 5 months, 39 days. That's a little over a month. Suddenly, the time required to move up $10 had compressed by almost 80%. The market was accelerating. The fuse had been lit. From $50 to $60, 12 days, not 39, 12, less than 2 weeks. Another 70% compression in time. The acceleration was accelerating. Traders who had been comfortably in control suddenly felt like they were riding a rocket that had just fired its second stage. From $60 to $70, 13 days. Basically the same as the previous move, but at a much higher absolute price. The velocity had stabilized